Good afternoon and welcome everyone. My name is Michal Oron. I'm the CEO and co-founder of Fortunet. Fortunet is an investment bank specialized in e-commerce. We're a team of more than 40 professionals, including investment bankers, financial experts, e-commerce professionals, and lawyers. And we were accompanied dozens of online native brands selling their businesses since 2018. The year 2022 was marked by significant developments, macroeconomics changes, and e-commerce related events. And when I spoke with our panelists today, surprisingly or not, they raised similar topic as the most noteworthy for discussion today. So we will talk today about macroeconomic impact on e-commerce, online advertising, new Amazon initiatives, social commerce, M&A in e-commerce space, Amazon dominance in the online retail industry, and AI, artificial intelligence. Just a general comment, please feel free to post questions during the webinar. The panelists and Fortunet team will answer all of them either during at the end of the webinar or afterwards privately. So let's begin with introducing the panelists. So together with me here are Juozas Kaziukėnas, James Thompson, and Ken Kubec. And maybe you can present yourself. So Joe, can you start?
Hey, thanks, Michal. Thanks for having me. I think you nailed my name as the first time. Amazing. I'm Joe. I write for MarketplacePulse, which I believe is the best source for interesting insights on Amazon and other marketplaces. And can't wait to share my thoughts in this webinar.
James?
I'm James Thompson, former Amazonian, used to run the FBA group at Amazon, also the co-founder of the Prosper Show, and spent many years at Buy Box Experts, an Amazon agency. Thanks for having me today, Mikhail.
Great to have you. And Ken?
Yep. Yeah, Ken Kubec, VP of Acquisitions at Prophetably, a new startup. Before that, I was VP of Acquisitions at Thrasio, oversaw 175 plus acquisitions over a 3.5-year period, and then kind of investing background prior to Amazon startup space.
Okay, great. So good to have you all. And let's start maybe with discussing the macroeconomics. 2022 was a turbulent year, which came after 2 previous turbulent years of the COVID pandemic. Yet in many aspects, this year is perceived as the year things came back to earth. At the same time, we've seen rising inflation leading to increase of interest rates. We've seen the US dollar strengthening and the recession as an imminent threat. Ken, we'll start with you. How do you summarize this year in the e-commerce space?
Yeah, I mean, in some ways, it was a little bit of return to normalcy in terms of the actual growth rates, as you alluded to, post the COVID bump, this 6 to 8 quarter bump, which we had. During that first 12 months, annualized e-commerce growth was 45%. And then we started to comp that against that at the end of, as we move through 2022. And now I think we've reset growth expectations to kind of mid to high single digit, which they were pre-pandemic levels. So I think in terms of as an e-commerce operator, there's a little bit more sustainability in your ability to forecast demand and growth rates. But inflation is real, it's here, and there's obviously trade down effects that happen during inflationary periods that historically, i.e. from discretionary spend to staple spend, i.e. groceries, need to haves versus nice to have. So there's also a shift of wallet that occurs during these times, and also from high price point tickets, items to mid-level to lower priced, and the kind of the Amazons and the Walmarts of the world tend to also take share in inflationary environments as people look to save money wherever they can.
So what do you think the impact of that would be on sellers? I mean, on the e-commerce sellers, as of cost, prices, profits, and growth?
I think being in, it's a time for sellers to think about, either products they're rolling out in the market, pricing strategies, right? Categories that they're venturing into, or are in, right? So I think to the extent that you're selling, discretionary items that are $500, that, my guess is you're probably going to face a little bit of a headwind on the sales side. And your customer acquisition costs will probably rise as, your conversion rates will probably start to drop a little bit. And also, even if you are selling staples, there's, Amazon pricing pressures are always prevalent on the marketplace. That could continue in a world where, volumes in general, if you look at Amazon traffic volumes, et cetera, they're definitely trending down year over year. So as people fight to maintain market share as well, right, you could see pricing pressure on the low end as well.
Well, what about competition during such times? So if I'm an Amazon seller these days, what should I expect?
I think it's double-sided. I think you could see probably less sellers coming into the market, right? A lot of, over the past 3-4 years, a lot of the Amazon sellers that have been launching products were doing it as side hustles. So they were, working as a sales rep or a sales executive at a tech company, and they heard their friend was getting into Amazon and they decided to venture into it, right? Maybe you allocate $5,000 to $10,000, $20,000, maybe of capital to start an Amazon business. I think that risk the risk reward isn't there right now for people to do that, just given the headlines, people's comfort and security level, right? There's tons of, you can't open up the newspaper or online and read about a tech layoff that's happening. Amazon just upsized their layoffs, right? So I think we've lived through an unprecedented period of record low unemployment. That's starting to turn, and consumer spending does dovetail with consumer confidence, which had been at a peak, and that's also starting to roll over. So I think from the threat of new entrants coming into your market, you're probably in a better position than you were 2 years ago as an Amazon seller. But you also are still fighting existing players that will be competing for market share and growth in a slower traffic environment.
So Joe, what do you think in such an inflationary environment we should expect with respect to the continued expansion of e-commerce? Is this a major headwind?
I think we are finally going to have a very stable year. Supply chain costs have normalized. Importing from China is back to normal. Advertising prices are kind of flat or okay. So things are not getting more expensive, and the growth figures are now realistic, as opposed to last year where we still weren't sure if flat growth was good or bad. But I think the one macroeconomics trend I'm looking at a lot is credit used by consumers, as well as the growing use of buy now, pay later. This doesn't apply as much to Amazon as it applies to direct-to-consumer brands. I mean, we saw reports by specifically Adobe about Black Friday and Cyber Monday that buy now, pay later was getting used so much more than in the past, and combined with credit of other types like credit cards, that to me sounds like a building bubble. And if the economy hits even bigger roadblocks, the consumer spending will continue because it's going to be driven by credit use, including buy now, pay later. But that eventually has to be paid down, and I think we could see serious issues and kind of a bubble bursting as it relates to consumer spending, which then in turn will affect all spending on all platforms everywhere. So I don't think we're out of it yet, and I think this year is still going to be challenging as consumer spending is unclear. But as far as like the back door, like back of the house, like running e-commerce, all of that stuff, I think is back to normal, and sellers should be fine.
So I want to share this just one slide for a second. Do you see this graph?
Yes.
This is one of yours, Joe. So what do you think will be next? I mean, we see here the graph gets up until Q3 22. So what should we expect going forward?
What's really surprising about the current state of US e-commerce is that e-commerce spending is massively up from what it should have been if COVID didn't happen. So it's also unclear of where is that spending coming from, how much of that is growth, how much of that is inflation, which channels are benefiting the most. But as you can see in the chart, we are 25% above the trend line, even though market share of e-commerce is not above the trend line at all. So we are spending a lot more in retail stores. We're spending a lot more online. It sounds good. It's unclear of how the chart is going to look like for the rest of the year, this year. To be honest, I have no idea, but I think it will start to soften and perhaps get closer to the trend line. But if anything, consumer spending, as long as it remains high, a lot of that will inevitably flow through e-commerce.
Okay, thank you for that. James, do you want to add here anything?
So when I think about this at the individual seller level, this really is a time of reckoning for sellers to be going through and figuring out at a SKU level, is their profitability on everything that they have in their catalog. If you think of Amazon as every ASIN is a different competitive set, during COVID, sellers were able to throw a lot of stuff on the site, and stuff just sold because everybody was running to buy stuff. But now that you're having to rationalize and ask the question, am I actually making money on each of these products? As the cost of capital goes up, as it becomes more difficult for companies to innovate and launch new products, I think this is really a good time for sellers to be asking themselves the question, have I pushed off this analysis of looking at each of my SKUs one at a time and figuring out, do I want to continue to have this SKU, this SKU, this SKU, and rationalizing every part of that catalog so that you do end up with as much working capital as possible to be able to put into the winners within your business. I work today with a number of companies that are going through this rationalization process and realizing that just because they grew 30%, 40% year over year in the last couple of years, many of them were just riding the wave. They weren't actually doing anything particularly well. They weren't operating better than everybody else. And to the extent that they want to continue to grow and grow at least as fast as the categories that they sell in, that's going to require some tough decisions and some analysis to look at their business piece by piece by piece and be in a position to say, am I actually positioned to grow faster than everybody else? Am I in a position to have more cash on hand than everybody else? Because the uncertainty that comes with these types of times requires one to have as much working capital as possible, not sitting on inventory that may or may not sell if consumers do or don't decide to buy stuff online. So I look at this 2023 really as a year of reckoning and discipline, an operational expertise around what does it take to be a really good operator of an e-commerce business versus being just any old e-commerce operator that happens to have inventory when competitors may or may not have access to product.
So challenges eventually will enhance the performance of the survivor.
I certainly hope so.
Yeah. Okay. So thank you for this, and we will go to the next topic. We'll talk now about advertising. For a long time, the most used advertising technique among Amazon sellers was PPC on Amazon. We've seen this technique governing together with the usual or other e-commerce sellers using display advertising, native advertising, and social media advertising. And James, we'll start with you. Are there now any other significant advertising means?
So there are, but I want to, before giving more specifics on that, I think it's important to understand Amazon designed PPC for it to be easy for anybody to start advertising. You got $50, no problem. We can start advertising your products. And for many private label sellers on Amazon, they decided to put their eggs in that PPC basket because it's easy. You can get started. You don't really have to be experts. There's a lot of software that you can use that makes life fairly easy. The problem is, if everybody's playing the game the same way, it makes life difficult to innovate. And so as we start to look at what are some of the other forms of advertising or other ways to drive traffic to your product listings, there are some very interesting developments that are happening. Number one, Amazon has launched the DSP platform a couple of years back, but it's still a by invitation model where you have to show up with large amounts of minimum spend each month. And so for companies that can spend at least $25,000 to $50,000 a month on DSP, the opportunity to do hyper targeted ads is much more robust than anything that PPC offers today. And I actually think that this DSP platform is going to become a humongous business for Amazon. We're talking $20-30 billion at some point, where Amazon is able to compete for what is otherwise print advertising dollars or TV advertising dollars that tier one brands are spending today. Given how much bottom of the funnel traffic Amazon offers advertisers and the ability now to do that incredible targeting and experimentation to learn more about customer behavior, I think DSP is going to continue to be on the radar for key developments at Amazon, at least for the next 4 to 5 years. Because quite frankly, if you look at what's happening with all the cookie developments on Google and Apple, Amazon's going to very quickly become the single largest source of 1P customer data, at least in the marketplaces where it operates. And that data is so incredibly valuable if Amazon decides to monetize it through DSP. I'm going to stop there because there's other things we can talk about within advertising, but I'm curious if either my webinar colleagues have anything else they want to add with regards to DSP.
Yeah, and I also want to add a question. If any of you is familiar with any leading technology that can allow DSP advertising management.
I think to me, DSP is probably less about the technology that you could use to kind of make use of DSP. It's more about the realization for Amazon and for everyone else involved that not only Amazon advertising could be used to promote products on Amazon, it could also be used to promote products of Amazon off Amazon, but also to promote of Amazon properties on Amazon. So not Amazon becomes the underlying advertising network, which can be used for all sorts of different advertising purposes, and it reaches platforms across the web, and it also promotes properties across the web. And I mean, you're starting to see, I know, car manufacturers or book writers using DSP to promote their products. And I think that the reason why James is saying that there's going to be a massive business, which I completely agree with, is because of that off Amazon use, which is even so much larger than Amazon itself. And yep. But it also means that the sort of the skill level required to use it and the expertise required to use it is perhaps going to be a challenge for many players involved. And this is something I've been kind of talking about a lot this year, is that I think Amazon ads are becoming built for machines or built for agencies. While you could start using Amazon ads as a seller with $50 a bunch of PPC ads very easily today, at a certain point, not only do you need software to manage advertising keywords and bids for you automatically, you also need something or someone to understand all the different ways Amazon advertising could be used. So Amazon advertising is not only becoming more opportunistic and more challenging, it's also becoming something that the skill level required, I think, is going to be the sort of the job to hire for this year and for years to come.
When you look at advertising dollars in the United States, I think the latest last year was somewhere north of $700 billion are spent on all forms of advertising. And to mirror what Joe was saying, when you start looking at the ability for Amazon to go after advertising of non-Amazon specific properties, but go after those ad dollars, what portion of $700 billion is Amazon going to get from its advertising platform in 5 years? Well, it's better positioned to go after a major chunk than anybody else. And when you start to think of things like Nielsen tracking, which, that technology really hasn't changed very much in 40 years and doesn't allow lots of different targeted subgroups. I see Amazon and its DSP platform being able to do some pretty revolutionary things, and nobody else is in a position to do anything even vaguely close to it right now. So, but back to your original question, Michal, DSP for me is something that will continue to be on the radar for quite some time. I do also want to mention another significant development within Amazon. This is the focus on how do we drive other forms of off-Amazon traffic to Amazon. So social media advertising, influencer marketing advertising, getting people who are visiting other types of websites to start to see products that they can then turn around and learn about and buy on Amazon. Already with some of the testing that I've seen some clients take on, Amazon is clearly rewarding brands for driving off Amazon traffic to their Amazon listings. And so I see a whole new ecosystem developing where it's not just, hey, let's do some Facebook advertising or some Instagram advertising, but let's actually figure out how to bring influencer marketing into this. Let's figure out how to ask questions around what portion goes to this form of social media advertising, what form goes to this form of advertising, and starting to balance these questions out. There's a lot of dollars to be had, but there's also a lot of techniques that, quite frankly, if you're an old school brand that's always done certain types of advertising, and now someone says, hey, you should be on TikTok, you're going to require different types of agency skills or internal skills that you don't otherwise have, because every one of these channels is its own language around how to understand customer needs, how to be able to put messages in front of them, and then how to ultimately be able to capitalize in driving that traffic back to an Amazon listing that's going to convert effectively. Amazon product listings, by definition, are nowhere near as exciting and vibrant as a TikTok video or a Facebook ad that has video. And so figuring out how do you get people to experience your product initially through an ad they see externally that may be more vibrant or evolving than what the Amazon PPC ad looks like, that's going to require brands on Amazon to do significant learning and use external agencies.
Yeah, I would just say, James, you basically pitched kind of profitably in what we're working on. Basically.
Please, maybe it's a good time for you to.
Oh no, I don't want to promote, but last time I was at Thrasio and promoted what we were doing, there was a lot of followers, so I want to be able to tag what we're doing now. But we think our thesis is that traffic is the new digital currency. And will continue to be, and that's just not Amazon or Google, right? It's all these things that James mentioned, right? Influencers, social, niche content blogs, and so I also think it's going to be, we're very bullish on Amazon and their advertising business, coupled with Apple's, right? And it's going to be really interesting to wake up in 5 years and see the split between Amazon, Apple, Google, and Facebook or Meta, how those market share shifts play out. I think Amazon and Apple are going to be share gainers and Google, Meta, share donors. So positioning for that and really educating yourself, as James alluded to as well. If you're a seller, you're no longer able to set it and forget it. So it's either using an agency, using cutting edge software that's being developed in the space. But you need to know advertising if you're an Amazon seller today. It's table stakes. That wasn't the case 5 years ago. It is today.
5 years ago, there were also just a few companies that did PPC advertising optimization. Yep. When I look at what's happening with social media and influencer marketing today, not a month goes by where I don't see another pitch deck from another company that is trying to get into the space to develop tools to make it easier for brands, whether they're selling on Amazon or selling DTC. And so it's going to be interesting to see who is able to develop not only the best tools, but who's able to go to market quickly and ramp up and grab a lot of brands that historically have poo-pooed the idea of social media advertising, but now wake up and realize that they better be conversant in some of these other forms of advertising.
So if I'm wrapping what you all referred to, it seems as if the new challenge for any e-commerce sellers on advertising is using machines actually. So instead of so that's kind of maybe Joe, you can
It's
refer
either
to
the
that.
machines or the agencies.
Yeah.
I think it was the Wall Street Journal who wrote an article about this maybe a couple of months ago, saying for a very long time it looked like the advertising market is going to be the duopoly of Facebook and Google, and then very quickly it exploded into Amazon doing ads, Walmart doing ads, Instacart doing ads, and then TikTok and everyone else doing ads. And now all of a sudden, that market went from constraining into 2 players to now exploding into dozens of them with their own challenges, with their own tool sets, with their own expertise. And all of a sudden, the need for agencies and the need for tools is ever great. So that's, I mean, ultimately for sellers, for brands, for anyone who's doing advertising, that's a challenge, and that's either a job or an agency they hire to replace this. But if you're selling online, just think that this is only going to get more complicated, and
Yep.
and to keep up to date, you have to find ways to do it.
Okay, maybe very quickly, just to keep up with the timing, what is your expectation about advertising cost, considering those expected changes?
I mean, as advertising cost tends to ebb and flow depending where is it most effective, where it's the cheapest, where it is underpriced, where it is overpriced. For a very long time, TikTok was exciting, and then everyone jumps to TikTok. So I think marketing tends to follow whatever is best performing today. So Amazon, I still feel like, is fairly underpriced for what it delivers, given the sort of how low it is at the bottom of the funnel. And at the same time, as James was talking a lot about the sort of the pressure for sellers and brands to be profitable, it can never explode in price. Amazon advertising can never explode in price because sellers would become unprofitable immediately. So it tends to balance itself out. And if you're finding yourself that the product you are selling today all of a sudden is unprofitable because the advertising prices have increased so much, that probably means that everyone else is selling it, has a better cost basis, and can afford to pay for that advertising. So it's always a challenge. It always ebbs and flows, and I think it's the reality that the advertising price is not fixed in time, and as it changes, you have to adjust your cost basis or figure out, can you stay profitable or not.
Yeah,
I do though see Amazon through DSP platform being able to buy a huge amount of inventory for advertising. Yes, within Amazon, there's only so much advertising space on page 1. Please, Amazon, don't add more, but there's only so much page 1 inventory. When you're doing advertising external to Amazon, Amazon can buy ads all over the place. And as long as those ads are converting, Amazon can keep buying more and more third-party inventory. And so its ability to keep prices fairly low, or at least growing at the rates growing at a slower rate than what PPC advertising within Amazon might grow. I think that reinforces the likelihood that Amazon DSP is going to become a huge business, but also one where brands that have the right expertise to manage those campaigns are going to be in a position to be able to make those kinds of campaigns cost effective.
Okay, interesting. So with your permission, I'll move on to the next topic, and very shortly, let's discuss the buy with Prime. This was launched by Amazon in the last April, and it's not only that, but other Amazon initiatives like AWD services. Just to make sure that everyone knows how it looks like. So here you can see. Do you see my screen?
Not yet.
I do not.
Not yet. Yeah, just a second. I wanted to share this one. Do you see it now?
Yes.
Yeah. So that's a random website selling banana phone, and this is how the buy with Prime looks like. Well, what is your take on that, Joe? Maybe we can start with you.
Amazon came out with an announcement today saying if you are an e-commerce store and you add Buy with Prime, your conversion rates will increase 25%, which is obviously unsubstantiated and probably wrong and probably an invented metric by Amazon to promote the service. But assuming that's true, assuming that it is true that if you add Buy with Prime to your website, your conversion rates go up 25%, I mean, everyone will have to add Buy with Prime because that's huge. It's a massive increase. But on Amazon also today announced that once you add Buy with Prime, you can also add Amazon product reviews to your website. So as people shop on your e-commerce site, not only can they check out with Amazon, but they also have the social proof, which is the Amazon reviews, which you might just have more of them on Amazon than you have on your own website. So Amazon is very clearly trying to reach through the e-commerce market as far as it can go, and it kind of plant its flag on every little website, and then give them kind of brand recognition by having the Amazon and Prime logos, but also transact more and more of commerce through Amazon itself. It's obviously, as far as I'm concerned, it's a Trojan horse because it does look like a benefit for brands, but I mean, Amazon tends to crack down over time. So we'll see whether it plays out. Today, there's not that many sites that use Buy with Prime. There's at best hundreds, less than 1,000. But Amazon also today said that now everyone can have it. It was an invite-only program or kind of a application process. Now everyone can have it. So we'll see how quickly sellers actually adopt it. But ultimately, Amazon's play is to bring commerce to more sites. And again, we were just discussing advertising. Your ability to drive advertising up to sites off Amazon and then still have a checkout of powered by Amazon on your website, which means you get a little bit more data than you would have had if you sold it on Amazon. And still it's your own website, but still the checkout happens on Amazon and then it's powered fulfillment by Amazon. I think you will see over time, basically every Amazon seller at least launch their own DTC website powered by Prime. And you will perhaps also see other brands experiment with adding Buy with Prime as well. But because I can imagine at every retail show, at every conference, Amazon is going to have a booth saying, add this button, you're going to have a 25% increase in conversion rates. If brands buy into that, you'll start seeing that button everywhere.
James, just really shortly, what do you think is Amazon's strategy behind these new?
So Amazon can offer fulfillment as a service, whether that's through Buy with Prime or Amazon warehousing and distribution. At the end of the day, every time there is a transaction that requires one of those services, Amazon collects more data. And I can't put all the pieces quite together yet, but as Amazon collects that data and understands behavior on Amazon, understands behavior off Amazon, I've got to think that data helps to reinforce first-party data that Amazon then turns around and monetizes through DSP. I don't want to sound like the guy waving the DSP flag all day today, but DSP and some of these other tools, the flywheel is spinning in a bunch of other glorious ways for Amazon, where if we get more traffic, it used to be all traffic on Amazon, now it's traffic outside of Amazon, but all that traffic is really data flows that helps Amazon get a better sense of what consumers are doing in terms of searching, in terms of jumping around from site to site, and then ultimately converting. All of that information helps inform first-party data collection. And when you have what will soon be the largest first-party data collection in the world that Amazon can then monetize, even if Buy with Prime doesn't have quite the adoption that it wants, or there's not quite as much traffic flowing through those that are using the tool, Amazon wins by collecting more data. So I think it's interesting to see how this plays out. When we look at Amazon warehousing and distribution, which is a separate service where Amazon essentially becomes your 3PL and says, listen, we're really good at warehousing. Why don't you use us for warehousing for the non-Amazon stuff? Amazon had multi-channel fulfillment in place years ago. This is a little bit different version of that. But again, Amazon wants to make it easy for people to sell online. And so the more of the complicated stuff that it internalizes and says, Mr. Seller, Miss Seller, you go build great products and source them. We'll figure out how to make all the other stuff easier for you. You know, at the end of the day, even if Amazon breaks even on some of these ventures, breaking even comes with a collection of a whole bunch of other really robust data that will further reinforce other very profitable parts of its overall company business.
Hey, James, what do you think about Amazon virtually doubling the multi-channel fulfillment fees this year? How does that play into their strategy to get sellers using Amazon as effectively a 3PL?
Multi-channel fulfillment fees historically have been viewed as very uncompetitive, at least comparing it to FBA. When a brand actually goes out and does forward distributed inventory across a network of warehouses, the costs are considerably higher than FBA. And so I think a brand has to go through the exercise of doing competitive pricing and looking to see what's it actually going to cost me if I go outside of the Amazon network. I think for a brand that has done that benchmarking, they're going to find that Amazon may not actually be as uncompetitive on pricing as they thought. The problem is we still have far too many brands that have all their eggs in the Amazon basket. And so for all these tools to be interesting, it requires a brand to make that decision. We are going to diversify beyond Amazon. We are going to recognize that consumers are interested in shopping outside of Amazon. And for brands that benchmark the performance of their business by saying, this is what my margin looks like on Amazon, this is what my margin looks outside Amazon, far too many brands have dipped their toe outside Amazon and said, well, it's not really worth the effort. Oh, and yet it is worth the effort. It's not about, do I make $1,000 here and $10 here? It's about, how do I start to think about being a multi-channel brand that is wherever consumers are shopping? That's a major mindset that brands have to make. And even if Amazon introduces all these different types of partial solutions, I'm not sure how we're going to get more brands to say, yes, I'm ready to diversify. Yes, I'm ready to need all these other services. Because in my 15 years working at Amazon and with Amazon brands just don't want to do this. They just want to keep doubling down on Amazon. So for all the convenience Amazon's created to make Amazon easy, they actually have to create more education around why it's good for brands to go outside of Amazon. And I'm not sure that Amazon's going to be the one that's going to lead that particular discussion.
Yeah, maybe it's a good time to discuss social commerce. Because with all those Amazon efforts, we do see that social commerce is in the rise, in line with the social media growing usage rate. So what do you think about that?
Joe, you want to take this one?
You start. I'll follow up.
So let's be honest. I'm not a TikTok user. I got myself a TikTok account. I went on.
You should be.
Tried to figure out
like
how.
The typical user.
No, but I got myself an account. I went on to try to figure it out. And although there may be opportunities in the next year or so where TikTok makes it more robust and easier for people to be able to buy products on TikTok, there's still this major issue of, I don't go to TikTok with a shopping list of things I need. I can go to Amazon with a shopping list and I'm going to find more than enough options to meet at least most of the generic needs I have. So how do we turn other websites like TikTok, how do we turn them into a structured buying experience where, as a consumer, I'm not just doing spontaneous purchase of random things that I see that look exciting, but I'm actually taking a major portion of my wallet on a repeated basis to go to TikTok to go buy my favorite shampoo every month or go buy my favorite jeans every 6 months. That part of the equation still needs to be worked out. And so the media is going to talk about, oh, look, TikTok's got fulfillment, is exciting. They're going to start selling a bunch of stuff. But that's kind of like going to the grocery store and deciding to buy a chocolate bar at the counter as you're checking out. It's great that you add a little bit more, but it's not systematic and organized and micro-marketed the way that the Amazon experience is. And so until some of that those other considerations come into play, social commerce or social media channels that then add commerce, it feels like random e-commerce. It doesn't feel structured, it doesn't feel repeatable, and it doesn't feel like something that's going to become a big concern for Amazon, because Amazon historically doesn't really have a bunch of random stuff they present you. It's all very structured. So I see this as very, very different customer shopping experiences. it's exciting to see what happens, but I don't get excited about it from the perspective of, oh my gosh, is Amazon going to take a big hit because TikTok decides that they're gonna have commerce?
Yeah, I mean, go ahead, Joe.
Go ahead, Ken. Yeah, go ahead.
No, I was gonna say, I mean, I agree with James. I think even just the way that TikTok's algorithm, right? Their algorithm's based on virality. And so if you're an influencer, you could post a video that might get 2 million views, and the next one you post might get 5,000 views, right? So the consistency of presentation of products, et cetera. And I think people are using TikTok more for entertainment, music. I think that's obviously a huge opportunity for the music industry with TikTok. But if you're an influencer, I think it's a great platform to build up your network and your follower base, and then maybe you're setting up, right? There's a couple of platforms out there that help influencers set up their own curated e-commerce store, right? Like, I think that's the future of social commerce, and that could be on Amazon, right? Amazon could have these curated stores for influencers, and maybe that they're plugging a link in their TikTok video to their Amazon curated store or their own, the Shopify store. But I do think that the buy with Amazon, right, is, Prime Now is an interesting hedge for Amazon in social commerce, right? So getting consumers used to seeing that button elsewhere on sites and in other platforms. I think it makes sense, right? It's trust, it's going to be delivered in 1 to 2 days. Whereas on existing, I mean, I had to pay $15 to ship a hockey stick the other day from a D2C site. And I was just like, this is ridiculous. And it's going to come in 7 days. I'm like pissed about it.
We'll ship it in 2 packages.
Yeah, exactly. Right. So I think when you think of Amazon, you think of reliability, trust, and speed of delivery. Which is
discovery. You can discover things as you need them versus, oh, look, this video, the person has a website and I can buy a t-shirt. Okay, great.
Yeah. I think it's the consumer journey, right? Is what everybody's should be looking at, and where you allocate advertising dollars, right? That, like the TikTok, the Instagram, right? It is, James, it's discovery. Oh, that looks cool. That looks interesting. I'll bookmark it, or that'd be a great gift for Christmas for somebody, or whatever it may be, right? Versus intent and owning that kind of quote last mile of the consumer's purchase, pattern, which is where Amazon, Joe, you mentioned bottom of funnel. That's the value that they have, right? It's super high intent when a consumer goes to Amazon and is typing in an unbranded search term. Yep. 80% of the time.
But on TikTok, you may develop brand awareness more in the old-time manner. This is something which is more rare to see.
Yeah, but that's right. Like the different buckets of advertising spend, like that's branding, right? That's not conversion and sales, right? That's a very different.
I'm not even sure branding matters on TikTok commerce. I'm going to see some random doodad, and I'm like, oh, great. I don't stop and say, now show me the brand name. No, that's not the brand name I'm going to buy. Do you have another brand name? So.
Yeah. Joe, do you want to add something, or maybe?
Oh wow! I almost completely disagree with everything said for the last 5 minutes, but I'll keep it short. So I think James' analogy for random commerce is amazing. I think it's a great way to categorize what social commerce is. It is in many ways random commerce, but so TikTok in China last year did 200 billion in GMV, not million, 200 billion. That's kind of 4 eBay's worth of sales of random commerce. So, I mean, just to say one thing, yes, random commerce is very different from what Amazon is, but random commerce is a huge part of how people shop. And I would also say that, Facebook ads, Google ads, they're exactly the same sort of random inspiration to do something else. You're browsing your Facebook feed, you see a Facebook ad saying, oh, subscribe to this service, click on this link, watch this video. You are randomly choosing to do something. That's where shopping slots in. So, yes, I agree that social commerce today is a very small part of TikTok, Instagram, and the rest. But at the same time, advertising on these platforms is huge. And ultimately, what social commerce in the West, in the US, is becoming is turning those advertising ads on social platforms into shoppable ads. So it just shortens the journey from ads you've already seen. So TikTok, Instagram, Facebook, Pinterest, Twitter, Snapchat, all of them are massive advertising networks for random commerce, and they drive a lot of those random commerce. And social commerce is now just becoming a way to check out on these platforms without leaving the app, which, if anything, just makes it more effective and faster, and it increases the conversion rate, I would imagine, massively. So this is a very different shopping model from what Amazon does. But I think for many types of products, it tends to work really well. I mean, absolutely. I mean, as Ken pointed out, like, you're betting on this ability to create virality, which is a losing game. I mean, it looks so easy and it looks so good when it works, but ultimately, if you're a brand and your experience is sourcing from China, you're not going to create viral videos for TikTok. That's just never going to happen. But if you can make it happen, then all of a sudden social commerce becomes a huge thing. So I've seen many examples of retailers or brands, I guess, being successful in this business of random commerce, which I think now we're calling social commerce random commerce. So it does work really well, and it is an absolutely massive thing. In the US, it is odd and weird. It's not as fully integrated as we've seen in China. And again, that's a whole different discussion of why it's different, why it's like that. But I mean, if you're a brand today and you don't have a presence on Instagram, you don't have a presence on TikTok, to be honest, I don't even know what you're doing. And if these platforms add more integrations, if anything, that just benefits you. Because, I mean, people spend a lot of time on TikTok, people spend a lot of time on Instagram, and those random interactions over time amount to a non-trivial amount of sales. So again, if you're a beauty brand, if you're an inspiration brand, if you're a home brand, even if you sell toys, that is a non-trivial amount of sales you can generate from these platforms. And I think over time it will increase.
Joe, let me ask you this question. You're consulting with senior executives at a brand, guys that are in their 50s and 60s who don't necessarily participate on Instagram, don't participate on TikTok. How do you get them excited about using these platforms when the Amazons and the Walmarts and the Targets of the world, those are models they understand a lot better? And again, I got a TikTok account because I had to learn, and it's like, wow, this is so weird. I don't understand how I would integrate this into my shopping life.
I think if you're as an executive are basing decisions based on your own consumer preferences, that's probably a dead end. Because I've been for years I've been to many conferences, and I'm like, hey, how many of you have used TikTok? How many of you have used Shein? How many of you have used other these apps? And usually no one raises their hand. And I think once you make a realization that like your own personal choices are not the same as everyone else's, and you have to understand what other people are doing. And I think we jokingly said, oh, James is a perfect TikTok user, because we are joking that TikTok is mostly for teens, but it's not for teens. It's used by everyone in all sorts of different reasons, and also different age brackets and environments. By this point, I would say everyone uses TikTok. So I think if you limit yourself to like what you are then that limits what you as a brand can achieve. Obviously, I don't know how to communicate that to brand executives, but ultimately, like my personal way of dealing with this is like I just open the Apple app store every month, and I download and install the top 10 biggest apps, and I try to familiarize myself with them and understand why are they popular and why people use them, because a year from now everyone will be using them.
Okay, well, we'll have to wait and see. You don't. It's not a must that the two of you will agree. Totally. So
thanks, Joe.
But it was very interesting to hear all of you. So let's move to the next topic and discuss M&A in the e-commerce space. If we have Ken, we cannot not discuss it. Ken, you are the face of Thrasio, and the face used to be the face of Thrasio.
The face of Thrasio, yeah.
Exactly, and also the face of promise. This is how Amazon sellers promise look like in a human's face. I mean, this is where they can get the real value of the brand that they've built. So can you explain what has changed in the aggregators play in 2022 and why?
Yeah, I think if I had to classify it for people, I think that 2018 to 2021 was what I would call the platforming period of aggregators, and I think it's transitioning to the product period for aggregators, and that's important for sellers. So I would distinguish the two periods. That the platforming period there was a land grab, a gold rush, whatever you want to call it, that was precipitated by a very cheap cost of capital, very low multiples in the space, right? I mean, when we started Thrasio, we were buying Amazon FBA businesses at 2x EBITDA, with very attractive cost of capital, right? That changed dramatically over the last 4 years as other aggregators were raising capital and coming into the market. And why I call it platforming, because the idea was pretty simple on the face of it, right? It was, you buy an asset for 2x EBITDA, you just kept it flat, you're earning 50% return on that asset. And if your cost of capital was 10%, you had 40% returns that you could then really invest back in the business to hire, to build out your platform, right? And still achieve a 20% net return, which is a great investment. As multiples rose, though, that window, the margin of error became a lot smaller, and you weren't able to reinvest out of the businesses you were buying, deploying that capital into platforming. So you had to actually raise capital specifically for what I'm calling platform, i.e. building out a team, investing in technology, trying to create an operating platform that then every incremental acquisition you made, if you're buying $1 million in contribution profit, you should be dropping $1 million to your bottom line, because you've your incremental margins are that much higher, because you've already platformed. So I think that period is over. There's still probably a few aggregators that were much slower to kind of acquire, and they still have access to capital, and are buying 1-2 businesses here and there, and really taking their time. But now it's transitioning to what I would term the product period, which is looking at real brands, industry leading products, no longer just buying anything that's out there for sale. And that's not a bad thing, right? I think if you're an Amazon seller specifically, and you're building great products, and you're increasing your rank, you have a brand story to tell, the products can be taken off of Amazon, et cetera, you're still going to get a premium valuation, and in the market on a relative basis. We can talk about valuations, but I think that the period of, you put a business up for sale, it's going to get sold regardless of the products that they're selling, is probably over, at least in terms of the Amazon FBA business. And then it's different on Shopify and D2C, because it isn't, right, this operational leverage that you're getting when you're buying subsequent Amazon FBA businesses. Each Shopify business is very own distinct entity in terms of customer profile, customer acquisition channels and costs, et cetera, that you're not necessarily able to leverage. So I think that's why you haven't seen the same fervor in Shopify aggregation that you did in the Amazon space.
So because of the shift into this product period, as you call it, you think that the pace of acquisitions will be slower?
Yeah, I think in general, just the macro environment, rising interest rates, the public equity market valuations, right? That all waterfalls into SMB, acquisition, private market acquisitions, right? If private equity and venture don't see, companies selling for huge multiples, or selling at a 50% of what they were trading at 2 years ago, that has a knock-on effect, right, down the stack. So I think in general, M&A volumes are going to be lower than they were the past 2 years across the economy. And then if you drill down in e-commerce, I think they'll mirror that. I think, slowing volume. I also think that the diligence process will take longer, which is something, sellers should brace for, just as buyers have time on their side in this environment, right? I mean, I remember the days where, somebody, if you hit the 60-day exclusivity period in diligence and you didn't close the deal, there were 5 other people waiting to pounce and sign a term sheet, on like an hour later. And so you had to speed through the diligence process. I think that, it has become a buyer's market. And that will continue throughout 23. And then, again, it's not a bad thing. If you have a great product, a great business, you're still going to be able to sell. There's no question about that. But there is this, this buyer seller valuation chasm that's kind of getting crossed concurrently across the economy. I mean, you see it across all different asset classes, right? From real estate to private companies, et cetera, that people are still anchored on the past 2 years valuation. When reality, I mean, you talk to any, I have a bunch of friends that are venture capitalists, and they went from grow, telling, their companies grow at any cost. All that matters is growth, to preserve capital, get your burn rate down to 18 months. We don't know when you're going to be able to raise again, right? I mean, that shifted like almost in like a 30-day period. And that, that's just the reality of the current, environment, and people just being more conservative, given where the economy is.
But maybe let's touch base again on the investment thesis here. So what happened with the vision of becoming the Proctor Gamble, the online Proctor and Gamble of the world? Vision that is shared by so many aggregators. Isn't it valid anymore?
Yeah, I still think it's valid.
Right.
Again, I think you have to differentiate between, I think not all Amazon products, right, lend themselves to becoming brands, and so there's value that can be created within a marketplace, right, i.e. within Amazon, of owning, the top seller in all these, quote, commoditized areas, right? That should be an annuity, that should act like a tide on a grocery store shelf, right? I.e. Amazon being the store. So I still think there's 100% validity in that model. What I think, the businesses that are gonna, don't fit into that model are, the fad businesses, a t-shirt print on demand on Amazon, things like that are, a lot of like one-time purchases, exploratory gifting, things of that nature. But if you own, the number one, shower curtain liner, the number one, wine open, like hand corkscrew that has 15,000 reviews, the number one pillow, etc. But like that's the P&G playbook on marketplaces. I still think that's 100% valid, and I think that's where, those are the assets that are going to get a premium, continue to get a premium valuation. Yeah, in at least the Amazon FBA ecosystem.
Do you think that valuations will ever drop all the way back down to 2x?
I mean, probably not. Just like I think there's a lot of validation of the asset class that happened over the last 4 years. I mean, I remember talking to, it wasn't Michal, but CEO of a prominent brokerage firm 4 years ago. And the response was, why the hell are you buying an Amazon business? Like, I mean, and so that's why they were trading at 2x, right? That was the mentality of the market, is this asset isn't worth anything. or we didn't even know you could do that, right? You didn't even know you could transfer an account and buy an Amazon business, right? So that it was a very compressed valuation in the asset class, just because of it was such a nascent market, right? I think, I would say 3 to 4 times like feels appropriate, 3 to 5 times, right? And that's, you can go out and buy a services business or a small, business doing 2 million of EBITDA in your hometown, and you could pay 3, 4 times, right? So that's not a bad valuation, right? I think it's going to be a lot more focus on what you do with it, what you do with the asset before, right? Like, or I'm sorry, after you buy it. And that was something that, everybody got anchored on, this kind of trailing 12 months. And when we were like, obviously you priced deals on that, and that's how the market valued companies, right? But we were always at Thrasio, we were always focused on what is the business going to do in the next 12, 18 months, 24 months, and what can we do with it, right? So the underwriting was all based around where's the growth coming from, right? Because, if you can buy a business that you think you're going to grow 100% in year one and double profit, you'd probably be willing to pay 9, 10 times for it, right? So it's more, the specific asset, and that's why I think that they'll probably shake out at like 3 to 5 is my guess, long term, which is what we kind of underwrote in the market in general when we kind of started Thrasio, that's where multiples would go. They definitely overshot, right? So they overshot because flood of capital. I mean, we all know the reasons: flood of capital, artificial growth rates, artificial incremental margins, people running out of stock, your competitors running out of stock. How do you analyze that in diligence and tease it out, et cetera? And then they're probably going to reset, and then I think they'll normalize.
Okay, that's I mean, I can pitch on how we see it at Fortunet. I just don't want to, I don't want
you
to.
You should. Yeah, no.
Yeah, Joe, you should ask me what is the exact multiple in the last month.
That's my favorite question, which you never answer.
We need to protect our clients.
I mean, a simple question is: what's your advice to sellers? Should they sell today, or should they wait 6 months or 12 months?
Yeah, there isn't one answer to that, and obviously we don't have a crystal ball, and no one knows what will happen tomorrow or any time in the future. But I can say maybe just for the sake of putting the full picture here. So first of all, when we look at aggregators, there are different aggregators that are in different situations. So some of them are failing. Some of them are succeeding a lot. It seems that, I mean, I haven't seen actual financial reports of aggregators, but it seems that they are doing very well. And others are in between, in different stages. They are now raising additional money, or they are restructuring their internal operation, improving part of what wasn't managed well before, refining their overall strategy. But we see them live and kicking, and in some cases growing. So I think that it's kind of, there was a balloon here that blew up in the sense that no one could seriously expect to see 100 aggregators just rising indefinitely. So that's about them, and then there are also others. There are strategic buyers that see those brands on Amazon growing, developing, creating a real fundamentals that can be leveraged. And as you mentioned, Ken, it all depends on what someone believes he can do with a brand after the acquisition. So we do see some that believe that those businesses are very attractive. And the same is with the private equities. The nice thing with these businesses, to some extent, moreover today, in a time where cash is worth much more, is that the good businesses generate cash. So if your business is to somehow deploy money at the time that cash is scarce, then you at least should consider or may consider to invest your money in a place that the day after it generates cash back. And I think, by the way, that this potential detachment between sellers' expectations and buyers' valuation of those businesses, if any such a detachment exists, it can be balanced by the worth of cash. So because if I'm a seller today, even if I sell for a bit lower multiple, assuming that I'm a good business, then at least I can get the cash and do with it so many other things which may be more solid, less risky. So it's kind of in the balance of things, it makes sense to do deals even today. And besides that, it's all about what is a specific seller's needs and personal view. And yeah, I see.
I would be a seller today if I owned. Yeah. I mean, I think, there's a decent percentage that the economy really falls apart over, in the back half of this year. And I mean, there's significant tail risk that's in the financial system. Not unlike there was in 2007. So, again, there's no perfect time. I always say it's like deciding to have your first child. Like, you're never gonna be. No, now's the time.
What if the roles were reversed and a seller came to you asking for a VC investment? Would you invest into a seller?
Yeah. I mean, I'm still bullish on the space, on e-commerce sellers. I mean, like you talked about it in your preamble around penetration of e-com, right? It's still a great underlying growth rate, right? And if you have the right operator and the right products and in place, and they know how to scale the business, yeah, absolutely.
Because it's a more in general question, I think, for both Michal and Ken. Like, are you seeing more sellers trying to raise money? Because I feel like we have not seen a lot of that in the past, but now many of them are perhaps saying, why should I sell now and get 3x or 4x? Why can't I just get some extra capital and just keep growing this business to be even bigger?
I think that there is not more openness to this kind of deals today from both sides, by the way. So if you're a seller, why not taking some chips off the table and keep on doing what you are doing well. And if you're a buyer and a certain buyer, not all buyers, but if you're a certain buyers and you want to learn the hard lessons learned by some of the aggregators, then you may want to consider just partnering with the entrepreneur, keeping him, in the business. So yes, I think we see more and more appetite to those deals. I want to really, I'm sorry, it's a sharp turn here just because I want to touch on very shortly on the other topics. So when we're talking, we see the Amazon dominance in the online retail industry as a whole. So maybe Joe, you can just roughly refer to Amazon market share and what should be the main implications of that to any e-commerce sellers.
I mean, Amazon is at least 40% of US e-commerce, but it is also, 80 or 90% of marketplaces. So if you're currently selling on Amazon, your choices are, or the off-market size is probably 10%, which is pretty small. Obviously, that has meant that we are seeing a lot of sellers kind of building businesses to be sellers on Amazon. We're not really seeing sellers starting as Walmart sellers. We're not seeing sellers as starting as Target sellers. Everyone starts at Amazon, and then you do something else, and then you try to differentiate and expand. That's obviously, for many different reasons, that's problematic, because Amazon has all the keys. It kind of is the jury, the court, and the jail system. It decides the rules. It enforces its own rules. And if you're a seller who is unhappy about any aspect of anything, really, you tend to have no choice. So there's a lot of people trying to review this and trying to see if there are better ways these marketplaces can be operating. Europe seems to be more proactive and has implemented many practices much earlier than the US has. To be honest, US has not made much progress at all. And if you talk to any seller, I feel like all of them would just want a more fair platform. And that's the one thing I think we're waiting to see the sort of the regulators, the FTC, to decide if Amazon should be fair, whatever the definition of fair is. And if that does happen, I think, if anything, the life of a seller could be improved. But in this conversation, I think it's always worth remembering that you have kind of three sides. You have consumers, you have sellers, and you also have platforms. And they all have their own preferences and needs. And that's the balancing act of trying to decide if Amazon is a monopoly or not, and if it is, how that should be reined in.
James, well, you don't. I know that you don't like to hear that Amazon is a monopoly. What is your take here?
I mean, the European Commission ruled or got agreement from Amazon a couple months back on behaviors that Amazon would change related to its private label business. I think the jury is still very much out on how Amazon is going to operationalize some of these changes. For example, in Europe, Amazon has indicated they're not going to use private third-party seller data. Okay, so today we've got thousands and thousands of private label sellers who go on Amazon and use some of the tools that help estimate market share and market volume, and they essentially figure out what kind of products do I want to go build based on the opportunities that I see. Even if Amazon goes to using the very same types of tools, one of the things that they did not agree to as part of the EU agreement had to do with how Amazon was going to merchandise its private label products. And it's important to understand there's a finite amount of space on page 1 of search. And if Amazon continues to have so much of that space for its private label products, or for being able to artificially inflate the search performance of some of its products, even if Amazon has mediocre products, it will get far more consideration, even if those products continue to be mediocre. And so the ability for Amazon to continue to be a better than average private label seller, in this case of its own products on its own platform, I think the devil's in the details, and we'll have to see how that plays out over the next 6 months as Amazon implements some of these agreed upon changes. Even if there are some meaningful changes that happen to the way consumers interact with products on Amazon, either through search or on the product detail page, I don't anticipate that things are going to move very quickly here in the US. You know, Joe talked about things being slow moving here in the US, and certainly there have been state attorney generals and there's been the FTC all asking questions and looking at different ways to come at Amazon. But at the end of the day, the devil is very much in the details around understanding that customer journey. From the moment a customer gets on Amazon and starts looking for products, how is Amazon still gaining advantage to make sure they get better consideration and better conversion on their products versus everybody else's? You know, we'll have to see how that plays out. I'm glad there's questions being asked. But, you know, for all the conversations we're having here about Amazon's dominance in e-commerce, earlier in today's discussion, we talked about Amazon DSP. Amazon, because of changes being made by Apple and Google, Amazon's going to wake up one day and all of a sudden be the largest first-party data provider for advertising. They didn't even have to go and do something that we might say is antitrust-like. They're just going to end up with that position, and they're going to be in a position where they're going to be able to make a lot of money on DSP advertising. Okay, do we now go and regulate that because Amazon happened to be in a position where its competitors decided to back out? You know, these are philosophical questions just as much as some lawyers may make them legal questions. But at the end of the day, Amazon has so many pieces in its flywheel where if it does something over here, it's going to create huge benefit for itself over there. And the regulators often are looking at one thing, one point in time over here, not realizing that there's all these additional externalities by way of the flywheel. So regulating a big player like this is always a situation where you're many years behind, and often several steps behind where the puck has already been moved to. And so I don't look at this and say that if you're a seller today, I don't anticipate that regulation of Amazon is going to have a major impact on how you as a seller are going to interact with Amazon anytime soon. I just don't see it happening.
Okay. What, Joe? Are you smiling because of what?
No, I think I mostly agree, but we will have to. I think this year is going to be a interesting year because again, in Europe they passed the Digital Markets Act, and one of the kind of changes in that act, or enforced by that act, is that once you have a sale on Amazon, Amazon will have to give you that customer's data, including their contact information, including their email, at least in Europe. And we will have to wait and see how that looks like in practice, because again, regulation and practice are two different things. But you might start to see this ability of selling on Amazon and then contacting these customers directly and then redirecting them back to your own website. Again, there's a lot of questions still unanswered, and it's unclear if consumers even want to do this. And there's a question of, is it spam or not? But nothing will change drastically for sellers, and sellers shouldn't be hoping for these changes as a ways to improve their business. They should just improve their business, because these changes will take 5 more years and then nothing will happen anyway. But things are happening, and I think as ineffective they are, and as long as they take, and as insignificant some of them are being, the existence of regulators is, I think, important, and hopefully, especially in the US, it moves faster, because I think applying back pressure to Amazon from regulators is really the only one who can apply that back pressure. And I think that it's just good for the economy. As powerful Amazon is, which I think has obviously benefited all of us, it does benefit from also having regulators.
And if that kind of unblinding of consumer information came to the US, that would be great for sellers. It would be great for actual asset valuation in the space would go up. That's one of the knocks is, right, you don't own the customer, Amazon does, so you actually had access. That would really open up some really interesting opportunities, I think, on the buy side, the aggregation side, around consumers and shoppers and avatars to consolidate brands.
And at the same time, if you're that brand that's now able to market to customers outside of Amazon, you better become more sophisticated in the ways of how to interact with customers, because it's easy to be lazy and rely on Amazon to do all the hard work. Just because you now have an email address of a customer doesn't make you a more profitable business.
Sure, but it just gives you a choice.
Yeah, and I would just add too on the regulatory side that Amazon's a massive deflationary force in the economy over the past 10 years. Like when a government's fighting inflation, typically, right, regulation and stuff, it doesn't lend itself to that. Like just look at batteries. There's a lot of deflation within the Amazon marketplace that they've precipitated in the economy. So
I think to be honest, that's probably one of the challenges of antitrust or deciding if Amazon is a monopoly. You will not find cheaper batteries than you could find them on Amazon today. So from a traditional monopoly point of view, Amazon is not driving up prices and thus being the bad monopoly. But I guess some people are trying to argue, especially Lina Khan of FTC, are trying to say that the modern local monopoly shouldn't just concern about consumers, but it should also concern about businesses and competition. So if Amazon is selling the cheapest possible batteries, and also no one else can compete on Amazon by selling batteries, is that good for businesses who are trying to also build a battery business? But again, that's a philosophical question of what is fair, what is unfair, and we don't really have an answer to that.
So maybe AI will have some answer to that, and let's move to the next. Do you see my screen here?
Yep.
Yeah. So so Joe, maybe you can explain for a second why is this relevant at all to this discussion?
I think we have been using AI or machine learning of various types for pricing, for advertising, for supply chain for many years now. And I think the next wave of using AI is going to come for product copy, is going to come for advertising design, is going to come for product images, and etc. And I think ultimately AI is going to be a tool sellers and brands and retailers use to make certain things faster and cheaper. So in this example, only one of these images is the real image, and the rest are generated by AI from that original image. I'll leave it up to you to guess which one of them is actually the real image. And this is coming from a few friends of mine who are building this thing, but there are many other people who are doing the same thing. And ultimately, what that means is, if you're a DTC brand and you have to create creative for advertising every day, because it's pretty common as you try to find which ads perform the best, you don't have to have designers anymore trying to do this. You can just have AI spit out you infinite amount of possible choices, even though some of these are pretty bad, especially that second from the left in the bottom row. But ultimately, this is just an example of what's going to happen. And these are not prototypes. These are not experiments. This is real. And sellers will soon be using these types of tools to just to shorten their operation. So I think currently many sellers have designers who use Photoshop to create ads very quickly. You can just do it yourself, much cheaper, much faster. And that's going to infiltrate in all sorts of different ways, all sorts of different paths of kind of creative work of both text and images and video over time. And I think that to me is kind of the exciting area of e-commerce, especially as kind of tools for e-commerce, is this ability to iterate on what you're doing so much faster and so much easier, because now we have AI to automate this. So in the same way you've seen chat AI and kind of been fascinating with what sort of things it can do from seemingly just a very short amount of text, all of that is now already being used today for creative work and for product images and advertising. And I think by the end of this year, most sellers will be using something like this.
So it seems as if we are now facing a limited window of opportunity for early adopters of these tools to gain some competitive advantage in the short term. But what will happen once these tools will be commonly used by everyone? How would a brand will be able to stand out? At least on everything which is related to content and in design and marketing.
As with everything, things tend to ebb and flow, and you just always adapt. I mean, in a couple of years, everyone will be using tools like this, and we'll find other opportunities to be unique and different. If you're a reseller and you write a lot of product descriptions and you write a lot of titles, and there's every tool, I mean, there's probably 100 tools on the Amazon space alone that will help you write better descriptions and titles. All that soon will be automated away. So you will go do other things which can still be up to you as a human. Ultimately, the most important thing, which AI could never replace, is the physical product you're actually selling. If that's as best as it can be, it will always sell, and everything else will move away from this. In the same way you're using AI to do repricing, advertising, supply chains, you will use it for creative, everything else. It ultimately just means that your operational costs will ideally decrease, and the effectiveness will only increase.
If I could add something here, I spent many years running an agency working with brands that sell on Amazon, and even if you got the best listings, the best ad campaigns, the best products, the best product reviews, it doesn't take away from the fact that you may not be asking the right questions around how to improve your business. You may not be looking at what other ways do we need to be operationally efficient, but also disciplined in what we do. AI doesn't help you become more disciplined. It doesn't make you more operationally pure. You have to have checklists. You have to have systems in place where you go through and you look at different parts of your business. You continue to ask questions. You continue to get rid of bad products and bring in good products. And yes, AI can help you make better decisions around what might be products to get rid of and what might be good products to bring in. But if you're not asking the right questions, it's not going to help. I look at AI as something that's going to help me build better ingredients, but it's not actually going to make me build a better cake. It's just going to make me build better ingredients. I still need to think about how do I put those ingredients together to build something that's meaningful and profitable and worth maybe one day selling to someone else. Just as 3 years ago, the big word was big data. Ooh, everybody needs big data. Now it's AI. Ooh, everybody needs AI. No, what everybody needs is common sense and discipline and opportunity to ask hard questions that say, do I or don't I have a strategy? Do or don't I have KPIs that help me monitor the effectiveness of that strategy? AI doesn't let you do that. So I don't want to poo-poo AI as a concept, but it's just a tool for building ingredients. We still need the discipline of smart people asking smart questions, making tough decisions, and doing the right thing to build their business.
Thank you for that. So guys, it was, I think that we came to the end of this webinar. I enjoyed it a lot, and thank you for participating. Please, each of you can maybe say the last words for this webinar. Ken, do you want to start?
Yeah, focus on profitability if you're a seller. Only good things come.
Okay. Who is next? Joe?
To be honest, I was just going to agree with Ken. With all the great things we talked about, with all the exciting kind of different movements in this market, the same thing that has always been true is that if the business basics don't work, nothing else will break it. So if you're unprofitable, social commerce is not going to make you profitable. And as James said, if you're unprofitable, AI is not going to fix your business overnight. I think in a difficult economy, it's always the most important to keep a business going and keep the basics going. When things go back to cheap capital and crazy growth, then you can go back and look for innovation and maybe invest into the metaverse. But in the meantime, focus on things that are actually real and try to stay in business. Because I think as exciting as e-commerce is, it has been challenging for businesses, and it will only remain challenging.
James, thank you.
I can't tell you how many sellers tell me they have secret sauce.
Yeah.
My conclusion is the secret sauce is discipline, strategy, which is around making choices, meaning you're not doing everything for everybody, and being able to be adaptable. And it doesn't matter whether you're in an up market or a down market, you still need to be able to do those things. And you need to get out of this mindset that somehow you're in the secret sauce business, because quite frankly, none of us are in the secret sauce business.
Nice. Thank you very much. Thank you. And hopefully.
So Michal, what is your outtake?
What's your
suggestion for this year? Don't leave us.
Yeah, always bring great panelists to your webinar. That's one conclusion. But yeah, I agree that the basics should always matter if you run your business, and you shouldn't get confused by the noises around. But at the same time, you should be learning all the time. This is a changing world, so you should adapt, not on the account of the basics. So that's mine. Thank you again very much. We've got some very enthusiastic comments, and thank you from the listeners here. So thank you all for sticking with us until now as well, and have a great 2023.
Thank you, Michal.
Thank you for having us. Take care, everybody.
Bye-bye.